I mean, if you're a newcomer to this subject, it's often kind of helpful to look at project finance with a real estate analogy, because a lot of people buy a home or they know a little bit about office building finance. So let's try to fit that into say an office building like the one we're in now, where a lender wants to make a loan against this office building. So here we are in Manhattan, we're in a big office building. Let's say this building could be worth $500 million, or it takes $500 million to build it. You know, generally speaking, here in New York, the lenders will put up to 80% of the value of this kind of building, which means the investors themselves only have to put up 20%. So the lenders are looking to the collateral, the value of building, you know, what it costs to build it, and, you know, the fact that that's worth a lot of money, as well as the leases of all the people that occupy, all the companies that occupy this building. So when the lenders consent to loan money to a real estate project of this size, generally they want to see a feasibility study. So they want to see, okay, is there demand for office space in this area? And how much does it cost to build the building, and will there be enough rental income essentially to pay the loan back? Then, before the building is even built, they want to see that there's people that will occupy it. So generally speaking, before you build a building of this size, you probably end up leasing it in advance, at least half of the building. So you're not building a building like this on speculation. And this is the same type of concepts we're going to see in project finance. One, the investors do a feasibility study with the lenders. Two, they line up customers for the project before it's built. There's a construction loan that is implemented, and so that loan is guaranteed by the investors for 2 or 3 years. And then once this building opens and the people come in and lease the property, the construction loan disappears and there's a permanent loan. So this is the same sequence we see in most project finances. So what does this building sell anyway? What's the product here?
Space?
Yeah, it's got one product, right? Space. That's it. So it's not diversified, is it? It's not like Nestle with hundreds of different products. It's got one product. So that's a bit of a risk from the lender's point of view. It's got an equity investment or a down payment. So the fact that there's a big down payment, in this case 20%, will tend to persuade the lenders that the investors will jump in and solve a problem if there is one. If, say, a tenant cancels the lease or something. It's a little bit like when you take a home mortgage out in this country. The lenders usually want a 20 or 25% down payment. They want the homeowner to have some investment in the property so that if there's an issue like the leaky roof or the basement flooded, the lender won't see the investor walk away, that the homeowner will stay there and repair it because they have an investment in the property. So it's the same thing in the commercial side. Now, there's a lot of leverage buyouts in the United States. It's the same principle. Most of the lenders are going to want to see a 20 or 25% down payment on a leverage buyout, believing that that sort of down payment will give the investors an incentive to repair the company if there's a problem. Any questions on our real estate situation?